All right, thank you for joining me this afternoon. My name is Tony Zhang. I am the Chief Strategist here at Options Play, and today we're going to be talking about how to generate income using Options Play. Can you guys hear me? Sound check. Just doing a quick sound check. If you can hear me, please type yes into the chat window. Okay, great. So today we're going to be talking about generating income using covered calls in your portfolio. And we're using this tool, or we're talking about this topic because this is the most popular topic amongst options traders. Pretty much every single one of you can utilize this strategy to generate income in your portfolio. It doesn't require any additional a risk to your portfolio to add cover calls. It generates income for you using the existing assets that you hold in your account. It's something you can deploy pretty much in any market condition, regardless of your views on the underlying stock. And that's what we're here to show you today, is how to utilize this strategy to help you generate some consistent income in your portfolio using the stocks that you currently hold. This webinar is for both beginners and experienced traders. So whether you're starting out, this is a great strategy for you to start with, or if you're an experienced trader, this is still a strategy that you should deploy on the existing assets you hold in your account. So if you have any stock in your account, you should be paying attention, because you can generate some additional yield for your portfolio using the stocks that you currently hold. I'll spend about 15 minutes, 20 minutes using the slides, because I do want to teach a few concepts to make sure that everyone understands what are the best practices when you're using this type of strategy. But what I really want to spend some time on is using the actual platform Options Play to show you how to take the concepts that we teach you today, and so that you know how to implement it right after this webinar. I want you guys to be able to leave in the next 45 minutes and feel confident in being able to use our tool and start selling some cover calls or cash secured puts in your portfolio. So let's go ahead and just get started. This webinar is recorded, so for those of you that are newer to options and you feel that you need some time to learn these concepts, we will send you the recording afterwards so that you can review everything at your own pace. I'll also include the slides when I send the recording so you can follow along with the slides. So today we're going to cover a few things. We're going to cover, number one, what is a cover call? Number two, why we should consider using cover calls. And most importantly, how can we generate consistent income using this strategy? So in order to do so, we have to better understand how you fit as a trader, because these types of strategies is not a one-size-fits-all strategy. It's not like I can just teach you one single way to do this. There's lots of different ways to do this, and it's really important to understand what your personal preferences are so that you approach this strategy correctly. And Options Play will help you with that process. So Options Play will actually help automate that whole process for you. So that's really what I'm here to hopefully help you guys learn. And then lastly, what we'll do is we'll talk a little bit about the exit strategies. Now, before I get started, I just want to get a feel for who's in the room here. I just launched a quick poll, so please answer it. I'm just trying to understand, have you sold the cover call before today? I want to understand how many people here in this room have sold cover calls and how many people are new to this strategy. Looks like we've got about 3/4 of the room here that have sold cover calls, and about 1/4 of you that are just learning. Great. So I'll focus a little bit for those of you that are beginning, meaning how to kind of get started with these types of strategies, and then we'll really get into the meat of this, meaning what should you be looking out for when you are selling cover calls in your portfolio. So here are the results. Just so you guys can see, about almost 80% of the room here have sold cover calls, which is great. And then the other 20% of you that are learning, hopefully you guys learn something new. And I hope this inspires you to start selling some cover calls in your portfolio, especially if you've traded options before, but you haven't sold a cover call. I really hope that, especially if you found that this was a little difficult, hopefully you'll be able to learn something from this webinar and actually start implementing these strategies in your portfolio. So let's go ahead and get started. Just for those of you that are beginners, what is a cover call? Cover calls are very simple. It requires your stock position of at least 100 shares in your account. So this is your existing stock position. You don't have to buy any new positions. Take the existing assets that you have in your account because you can utilize them to help you generate some income. Because with your existing stock positions that you currently hold in your portfolio, you can sell a call option against that stock position that you own, and that is what's called a covered call. So you're selling a call that's covered both with the stock that's currently in your account. And by selling that call, you're going to bring in some income. So let's talk about what that income does. Number one, it generates consistent income in your portfolio because options expire. You can do this week after week, month after month. And you want to be able to do this so that you can do this over a long period of time so you can generate that consistent income stream. And this income stream actually lowers the volatility of your portfolio and the net cost basis of the stock that you own. So this is really something to look for in your portfolio. If you're trying to lower the volatility of your portfolio, this is a great way to go about doing this. And you use it on the existing stocks in your portfolio. That's my favorite part because you don't have to add any additional risk to your portfolio. You don't have to do anything. You just simply add it to the existing stocks in your portfolio. And that's really why this is the strategy that is most applicable to pretty much everyone, because almost every single one of you on this call has some stock in your account, and this is the strategy that allows you to implement options on that stock position that you have. Now, there's some limitations to this. It does limit the upside return of your stock. So we'll talk a little bit about this because that helps you determine, because selecting your strike prices determines how much you limit your stock upside return. So it's really important to understand how that affects it. It does require at least 100 shares of your stock. So if you have some stock in your account that you only have 50 or 60 shares of, this is not a strategy you can use that for. It has to be at least 100 shares. And at the very end, you do risk losing your stock. So we will talk about the exit strategies because we want to make sure you understand how to minimize the risk of losing your stock, especially if you don't want to lose your stock. So we'll talk about the exit strategies and how to manage them so that you have a very small risk of losing your stock when you're selling your cover calls. So how do you generate consistent income using this strategy? And the key to it is actually, number one, understanding that it's not a one-size-fits-all strategy, that we all have our own personal preferences. So some people might be very aggressive. Some people might be very conservative when it comes to their risk tolerance. It's important to understand how that affects your cover call strategy, because once you're able to select the correct criteria for you, that's how we're going to be able to help you gain consistency through the strategy. Now, the only way to have consistency using the strategy is to select an expiration and strike price that's suitable for your personal preferences, and using the same methodical approach week after week, month after month, year after year. And I know that sounds really simple, and it actually is, but however, what I tend to find people tend to deviate from is the actual practice of it. People understand that they should pick the same expiration dates and same strike prices week after week, month after month, but rarely when we're doing it manually do we tend to stick to that. And that's really part of the problem, is when you do this manually, sometimes you forget, sometimes different things come up, and sometimes emotions comes into play. And that's really kind of when we see people deviate away from the strategy that they've set for themselves. And that's why options play is so important, because we help automate this process for you. So there's no emotion that's there in the process of selecting your cover calls. We select the cover calls that's most suitable for your expiration dates and strike prices. So that's really why I want to show you how to utilize what we're showing you here today in the slides using options play, because it'll help automate your strategy and help you stay consistent in your cover call selling, or short puts for those of you that are selling puts. So like I said, covered calls is not a one-size-fits-all strategy. And when you're selling covered calls, there are two things you need to select: expiration date and strike price. So let's talk about expiration dates. What are the different selections that you can have, and how do they impact your covered calls? So right up here up top, I have three different categories. I have active traders, casual investors, and buy and hold investors. Active traders are people like myself. I have the ability to trade very actively. I can trade I have the time to look at my portfolio pretty much every single day. And if you fall into the same category as me, you would typically take expirations that are short term. So anywhere from 21 to 49 days out. So 3 to 7 weeks out. And this is really the weekly options, because you have weekly options listed anywhere from 1 week to 7 weeks out. Okay. For the buy and hold investor, this is for those of you that are really long-term investors. You might look at your portfolio once a month or once a quarter. You would typically want to sell long-dated options. So long-term options, anywhere from 90 to 180 days out. So 3 to 6 months out. And then for many of you, you may be somewhere in between that. This is what I call a casual investor. You might look at your account once every couple of weeks or once a month. You would typically do medium-term options or select expirations that are medium-term, anywhere from 50 to 89 days out. So those are usually the monthly options. So what I wanted to really, not just tell you which expirations to select, but also show you what the impact of expirations are on the actual income that you receive. So when we're trading, when we're selling options, how far out we go is really a factor of certainty, because when we sell a 1 month option, there's a fair amount of certainty as to what may happen between now and 1 month from now. So things that impact stock prices, like earnings dates, dividends, products, and news announcements, these are the types of things that you tend to have a fair amount of visibility into 1 month out. Conversely, if you're selling 6 month options, there's a lot less certainty as to what's going to happen in the next 6 months. You may not even know when the next earnings date is. You may not know when the next dividend date is. You may have no idea when the next product launch is. You have a lot less certainty into what's going to happen when you sell a long-dated option, or a 6 month option. So what happens with that is you're going to receive more income for that. You're going to be paid in more income for going further out. If you're selling a short-dated option, you have a lot more certainty in what's going to happen between now and expiration, and what that results in is a lot less income. So a lot of people say, well, why don't you just sell whatever gives you the most income? And that's a really good question. So what we wanted to do is we wanted to test selling short-dated options and also selling long-dated options over a long period of time and see what actually happens to these strategies. So we back-tested the S&P 500 stocks for the last 10 years. And here's what we found. We found that it's actually best to stick to the shorter term options. So the weekly options, so the 3 to 7 week options, gave us the highest return overall when we're doing cover calls. And the reason for this is actually because of two things. Number one, you generally want to avoid selling calls during earnings, okay? Because that was the largest contributor to losses to selling cover calls, is when you hold the cover call through earnings. Now, when you sell a 1 month call, so if you sell a short-term call, you can do that roughly 12 times a year. And we know that there's 4 earning cycles every single year. So 4 out of the 12 cover calls that you sell have this large uncertainty factor built into it. So roughly 25% of the calls that you sell have this large uncertainty factor built into it. When you're selling a 3 month call, you can only do that 4 times a year. However, that means for every single call that you sell, there's an earning cycle built into it. So 100% of the calls that you sell have this large uncertainty factor built into it. So you really have no way of avoiding it. You just have to deal with that uncertainty factor. Versus when you're selling 1 month calls, you can actually avoid selling those months that have earnings and still sell the other 8 months out of the year. And that's really why we prefer selling short-dated options, because from our backtest, it has clearly shown that it's better to even avoid selling cover calls during those earning cycles and only do it when there's no earnings. The second reason that we have found why selling cover calls, selling shorter dated calls is better, is because premium is not linear to time. What I mean by that is if you sell a 1 month call and you get X amount of premium, let's say you get $1 for a 1 month call, what we find is that when you're selling the same 3 month call on that date, you're not going to get $3 for it. Just because you're going out 3 times in time you're not going to get paid 3 times in premium. You're roughly only going to get paid 2 times that premium. So if you sell a 1 month call for $1, you're generally going to find that 3 month call is maybe only going to be trading around $2. So what that means is that you're not getting paid fully for that large uncertainty factor that you're taking. So and what we we found is that you can actually sell a 1 month call twice, receive the $2, and actually skip that third month when earnings is about to come out and still receive the same amount of premium as someone who's selling a 3-month call who still has that large uncertainty factor built into that cover call. So that's really why we've generally found that when you're selling cover calls, you're better off sticking to the shorter end of the spectrum, 21 to 49 days out. Using the weekly options will give you a better performance in the long run. Next, let's talk about strike selection. How do you select the appropriate strikes? So before I talked about when you're selling cover calls, you're limiting the upside return of your stock because the strike price that you sell is the strike price that you have to give up your stock at if the stock trades above that strike price. So it's really important to select the appropriate strike price for your risk tolerance. So I have three buckets here. I have conservative, optimal, or aggressive. So if you're conservative, that means that you really want to minimize the risk of you losing your stock. Maybe you've had the stock for a very long time, you have a very low cost basis to it, you don't want to sell this stock because you want to hang on to it, or maybe you have some dividend paying stocks that you rely on that dividend for. You want to keep your stock. You would fall on the conservative end of the spectrum. So this is where you would choose strike prices that have roughly a 10 delta or about a 90% chance that this call is going to expire worthless. So 9 out of 10 calls that you sell should expire worthless, and you only have about a 10% chance that your stock will get called away. On the other end of the spectrum, we have your aggressive traders. This is for those of you that are really trying to chase your yield. You're trying to maximize yield. You want to make sure that you get as much yield on your cover calls as possible. For those of you that fall into this category, you want to choose strike prices that have roughly about a 30 delta or about a 70% chance of expiring worthless. So 3 out of the 10 calls that you sell, you should expect your stock to potentially get called away. And then most of you will probably fall somewhere in between these two extremes, such as myself. I fall into the optimal camp, meaning I'm not too conservative, I'm not too aggressive. I want to choose strikes that roughly have about a 20 delta or about an 80% chance of expiring worthless. Now, the reason we're using delta to select our strikes is because of the fact that we want to account for the fact that sometimes markets are bullish, sometimes markets are bearish, sometimes markets are volatile, sometimes markets are not volatile. How do you account for all of these different changes? And delta is really the only way. If you use another way of selecting your strikes, and another popular way of using it is selecting a strike that's, let's say, 5% out of the money or 10% out of the money. That's a very common way to do it, but that doesn't account for the fact that sometimes markets are more volatile and other times they're not as volatile. So if you always select 5% during a non-volatile time, that might be sufficient, but when the markets are very volatile, that 5% may not be sufficient. So that's why we use delta, because delta will actually adjust for that, okay? Because it will always give you the strike price that has a certain probability, and that's how we get consistency. So if you're selling a 20 delta call with an 80% chance that that call is going to expire worthless, no matter what, you're going to see that about 4 out of the 5 calls that you sell will expire worthless. And that was one of the things that we wanted to test to see if that held true over the last 10 years. And out of the S&P 500 stocks, we found delta to be an extremely accurate predictor of the probability of the stock being called away. And that's why we use that indicator versus anything else when we're selecting our strike prices. So I wanted to also illustrate a little bit about what you're getting when you're selecting different strike prices. So when you select a conservative strike, that means you're selecting a very high strike. And this gives your stock a lot more upside to grow before the stock gets called away. In exchange for that, you're going to get less income for this. Versus if you're selling a very aggressive call, you're going to sell a lower strike, which gives your stock a lot less upside, but this gives you more income. So the question is, which one should you choose? So we wanted to test all of these different strategies as well, not just the expirations, but also strike prices to see which one gave us the highest return in the long run. And the answer actually was more on the conservative end of the spectrum. So, and the reason for this is really because cover calls or selling any option really has a negative risk to reward ratio. What that means is that the reward that you receive is limited to the premium that you're receiving However, the lost opportunity, meaning if the stock goes above your strike price and continues to go, it's not a loss to your account, but it is a lost opportunity because you could have made money on that stock that you didn't. And that lost opportunity is unlimited. So that negative risk to reward is what contributes to the big underperformance of cover calls. So when you sell very aggressive calls, you might collect an extra 20, 30, or maybe even 50 cents, but the upside that you're losing where the stock might shoot up $10 above your strike price, that's unlimited. So collecting that extra 20, 30 cents is typically not worth losing out on a few dollars of share price performance. So that's why, from our perspective and based on historical backtests, giving your stock upside is more important than collecting fat premiums by selling very aggressive calls. So now that we've learned how to select an expiration and strike price and talked a little bit about what we've seen works and doesn't work in the long run, how do you know once you've selected your expiration and strike price whether or not you're getting enough income? Sometimes you select the expiration and strike price given using the template that I just gave you, but sometimes you might find that that call is only giving you 5 cents or 10 cents or 20 cents. How do you know that it's enough income? So the answer to that is you want to compare the cover call yield to the dividend yield. Now, if you're wondering how do I calculate cover call yields, don't worry, Options Play does that for you. Okay, so what you want to do is compare the cover call yield to the dividend yield of the stock. And the rule of thumb here is you want to beat the dividend yield with the cover call that you're selling. So if you're selling a cover call that has a 3% yield on a stock that pays a 1% dividend, that's a great outcome because you've beat your dividend yield, you've increased your yield on the stock from holding the stock from 1% to roughly 4% by adding the cover call. So that's the type of cover calls that you want to look out for. If you have another cover call situation where you're getting a 3% cover call yield on a stock that pays a 3% dividend yield, this is kind of your bare minimum. This is your minimum threshold that you want to achieve in order to be worth selling a cover call and taking the risk of losing that stock. Conversely, on the last possible scenario, if let's say you're looking at a cover call that pays a 1% dividend, a 1% cover call yield on a stock that already pays you a 3% dividend yield, this is where you generally want to avoid selling a cover call because you're not increasing the yield enough in order to justify the risk of selling a cover call. You want to beat that dividend yield. So make sure you keep that in mind. And I'll go through plenty of examples so that I'll show you how to compare the dividend yield to the cover call yield so you definitively know which strategy is best suited for you. So just to sum up, and I'll get to Options Play in very quickly in a few seconds. Just to sum up, when you're selecting your expiration dates, you want to prioritize certainty, meaning having clear visibility into what's going to happen between now and expiration. You want to prioritize that over getting a huge premium, meaning trying to go further out and getting more premium. And when you're selecting your strike prices, the most important thing is giving your stock that upside room to run, because that's why you own the stock. That's why you want to stay in that stock. And that's more important than collecting an extra 20 or 30 cents by getting very aggressive on your cover calls. And that is going to help you gain more yield on your cover calls in the long run when you're selling this strategy. So to sum up, with the expiration dates based on our historical backtest, we're seeing that when you're selecting expiration dates on the shorter end of the spectrum, 21 to 49 days out to roughly the weekly options that are listed because they're listed out to 7 weeks. You should stick to those types of options for the best results. Weekly options typically also give you a lot of flexibility in terms of the strike prices. So, somewhere in between that optimal and conservative camp, so around a 15 delta call is where we find that sweet spot that you get the best yield, if you will, but that's offset by still giving your stock enough room to grow. And then what we've shown is that historically that performance is roughly about a 3.5% annualized return on top of the stock positions by following these types of strategies for your portfolio. So let's go ahead and actually show you some real examples using Options Play. So for those of you that are brand new and maybe have not seen Options Play before, this is the platform. Welcome. This is a tool that's designed to help you quickly find what's currently going on with the underlying stock, and how and leverage that into a trading or income strategy instantly. So we have trade ideas and watch list here on the left. Trade ideas give you fresh bullish and bearish ideas that you can sort and filter by every day. Our watch list feature allows you to quickly set up, currently looking at either the watch list that we've already set up for you to see what's currently going on with the sectors, or to drill down into the individual sectors, you can do that. But right now you can also set up your own cover call watch list, which is what I have set up here for our demonstration today. Our security analysis panel here in the middle is designed to allow you to quickly find what's currently going on with the stock. So we have both the 1 month and 6 month trend indicator. We have a technical rank to let you know the relative strength of a stock, so you can quickly see how strong a stock is compared to the overall market. And then we have trading and income here. This is designed to help you quickly find bullish and bearish strategies if you're trying to trade a directional view on an underlying stock. And then income, which is what we're going to focus on here today, if you're looking for cover calls and short put opportunities. So when we click on the income tab here, this is what we're going to focus our time on today. If you're interested in selling cover calls or cash secured puts, make sure you click on the income tab with options play. And at the very bottom, you'll see a button that says income settings. This allows you to create those time frame and risk tolerances based on what we spoke about before. So we talked about having choosing the time frame based on how frequently you trade, so you can choose short, medium, or long term. So I've chosen short term because I'm fairly active with my trading. I can see exactly what strategies I want to trade. I want to trade shorter dated options. With risk tolerance, like I said, I'm more on the optimal track because I'm not too conservative, I'm not too aggressive. So select the one that most suits you and then click on Save as Default. And for those of you that like to sell cash secured puts, I know some of you on this webinar will do this, you can actually set these independently of each other. So if you like to sell puts, you can also put in your settings for puts. So when I sell puts, I like to get a little bit more aggressive. So I select aggressive for my risk tolerance when I'm selling puts. Once I do that, I'm just going to click on Save as Default, and this is how we're going to gain consistency, because instead of searching through the option chains every single time, we're going to help you choose the cover call based on your personal preferences. So I actually have one other poll here I just want to get a feel for those of you that do sell cover calls. How do you currently select your cover calls to sell? Do you use options play? Do you use an option chain? Or do you use another source to find your cover calls? Looks like most of you actually use the option chains. Great. I want to go through a couple of examples here and just kind of show you the difference between the two, because it is worlds apart. And I want to show you, and I hope you guys are able to see this and see what I mean when I'm saying that using the option chain sometimes is extremely useful, but it can also be quite tedious. So here, as you can see, about 22% of you use options play, which is great. I hope that you guys have seen maybe this webinar before and find it useful, but most of you use the option chains. That's okay. I want to show you guys the difference, and a few of you use another source to find your cover call. So I hope that once I give you this demonstration, you'll see how much easier it is to use options play to find your cover calls versus using an option chain. So when you're using an option chain, like I said, even if you have the same methodical approach every single month, then you have to remember, hey, I want to do short dated calls, so I'm going to look for June. Maybe that's the right expiration for you. Then you have to use some other tool to help you determine what strike price, so maybe use delta. So then you have to do a lot of manual searching. So you have to say which one's the 30 delta or 20 delta, whatever it is that you're looking for. It's a lot of manual process. Versus on options play, all I have to do is type in my symbol. It instantly goes through the chain, finds me that short-term call, finds me that optimal call, and returns to me exactly where I should start. So Apple's trading at 164.22 right now. I can simply select, do I own shares of Apple? Yes, I can type in the number of shares. So let's say you own 200 shares of Apple. It immediately tells me my starting point. I don't have to pull up a chain. I don't have to search for the 30-day option. I don't have to search for the 20 delta call. It does it instantly for me. And what this does is it not only helps me save me time, but more importantly, it gets me consistency, because when I'm looking at that chain, sometimes I'm a little bit more, I might want to chase a little bit more yield because I see that the 175s gives me $1.93 versus $1.33. So sometimes I want to get that extra 60 cents. And what ends up happening is I let my emotions get the better of me, and I start deviating away from my strategy. And that's when you start to lose that consistency. Versus with options play, you don't have to do that because it instantly tells you what cover call to sell. So this tells me to look at the May 18th 175 cover calls on a stock that's trading at 165, so about $10 out of the money that expires in 22 days. And it tells me exactly what the yield on the call is. That's something that I couldn't get from when I'm looking at the chains. I couldn't tell you how much yield that 133 was over the next 22 days. I have to calculate those manually. Here, it does that calculation for you. So it's a 10% yield on a stock that currently pays a 1.5% dividend yield. So if you own Apple, which many of you guys do on this call, you're going to increase your yield from 1.5% from the Apple stock that you own today to roughly 12% if you're able to do this the whole year. Okay, so that's why it's so compelling to consider adding covered calls to your portfolio, because it takes the existing stocks that you have in your account and starts to help you add yield to your portfolio. And our tool makes it so simple for you to find that covered call to sell. You don't have to guess all the time using an option chain trying to figure out what's the right covered call strike and expiration to sell, because once you put in your settings, all you have to do is type in the stock. Let's take a look at Facebook, and within 2 seconds, I don't have to pull up a chain. I'll know exactly which cover call to sell on Facebook, which is trading at 174.5 right now, so right around 175. This is telling me to take a look at the May 18th 185 cover call. So again, about $10 out of the money. This expires in 22 days. And it gives me an 8.7% yield on a stock that currently pays me no dividends. So if you own Facebook stock, you are getting zero yield today. You can add some yield to your Facebook stock by selling a covered call. So, and this is saying that the stock, we don't think the stock's going to go above 185 in the next 22 days. And as long as that happens, you keep your 8% yield on this covered call. So this not only helps you identify exactly which calls to sell very, very quickly, but it also tells you how much yield that you get so that you can know whether this is worth the risk of taking this covered call or not. And I'll show you this very quickly. I just want to go through a few different stocks. I want to show you how easy it is to go through a list of stocks that you own and very quickly decide which stocks have covered call opportunities and which ones don't. So Pepsi's trading at 103.26. This is telling me to look at the May 18th 107 cover calls. This is telling me the yield here is 5.9%, so about 6% yield on a stock that pays a 3% dividend. So as you can see, my 12-month projected yield on this cover call is 9%. So I'm increasing my yield for the Pepsi stock that I own from 3% to roughly 9%. I'm tripling the yield on my Pepsi stock. This is why this is a strategy that many of you trade. This is why this is the most popular option strategy by traders. And this is why, it's a strategy that I think many of you should look at, because you take the existing stocks in your portfolio that isn't doing much other than earning you a 3% yield, and now you're increasing that yield on your portfolio. Let's just look at a few more. Johnson & Johnson. I'm just picking some big name stocks that many of you may have in your portfolio and showing you how easy it is. If I was pulling up an option chain, it would take me at least 30 seconds to find the strike price to sell. So now it immediately tells me the May 18th 132 calls. This stock's trading at 128, so roughly $4 out of the money. And it calculates the yield of 7.4% for me on a stock that pays a 2.6% dividend yield. So this brings my total yield to 10%. you're currently getting about 2.25. So you're roughly quadrupling your yield by selling cover calls on your Johnson & Johnson stock. And this is all done within just a few seconds. And for those of you that are brand new to this strategy and you're still learning, that's great. We break down this strategy for you in plain English. So selling that May 18th 132 cover call will generate $57 in premium, so $57 in income for every 100 shares. You can even enter the number of shares. So if, let's say you own 500 shares of Johnson & Johnson, it'll tell you that you'll generate $285 in income. This produces a 7.3% annualized return, and there's a roughly 78% chance of expiring worthless. So this is right in that 80% target that I'm looking for because I'm an optimal risk tolerance. I want to sell cover calls that have approximately an 80% chance of expiring worthless. So about 4 out of the 5 calls that I sell will expire worthless, and about 1 out of those 5 calls, my stock will get called away. So this is really where you can gain consistency by using automation, because instead of having to manually go through the chains every single time, you can go through these, you can use this tool to help you quickly identify which is the cover call to sell instantly and be able to trade this. So Intel actually just reported earnings after the close. I actually haven't had a chance to take a look at it. So let's look at a different stock real quick. IBM's trading at 146. This is telling me to look at the May 18th 152.5 cover calls. And the other thing I want to point out is that right down here at the bottom, that tells you the next earnings date. So we talked about avoiding selling cover calls into earnings. So it's really important to know when that next earnings date is. So we actually display it to you at the bottom of your chart here so that you don't have to go somewhere else to find that. And once you've discovered the cover call here, so you here I'm looking at the May 18th 152.5 cover call, tells me my yield is 4.4%. Notice here, this is actually one of the examples here where I just barely meet the minimum yield. So IBM pays a 4.3% dividend yield, which is quite high, and this cover call here gives me a 4.4% 4.4% yield. So I'm just meeting that bare minimum threshold of being worth my while, because I'm doubling my yield from about 4.5% to about 8.7%. So here's an example of one where, this is kind of the minimum threshold. And once you've discovered the trade that you want to make, so for example, if this is an IBM covered call that you want to sell, you can hit the trade button, and what we have is what's called a strategy checklist. So for those of you that are brand new, I highly recommend you take a look at this. We check for a few different things just to make sure you understand your risks before you place your trade. So especially if you're brand new, take a look at this. We'll check for the probability of expiring worthless. We'll look at the annualized return. As you can see, this is telling you it's average, meaning it's not a spectacular cover call return, but it's okay. There's no earnings between now and expiration, so you know that for a fact. And then lastly, we'll also check for spread and liquidity. Really important to understand how liquid the option is before you sell it, so that if you ever have to get out, you know how liquid something is. Very, very important. So just to kind of a recap before I kind of move on here, what I highly recommend you to do if you set up options play is first create a watch list with all the stocks that you own. This way you don't have to manually type in all the stocks for the cover calls that you own. Once you do that, you can click on the income settings to create the settings that best suits you, time frame and risk tolerance. You can set these independently for calls or puts. So if you sell cash secured puts, you can use this tool as well. Once you save them, that's it. You can click on any stock and we will return to you both the cover call idea. So Walmart's trading at 87.94. This is telling me to look at the May 18th 93 cover calls. If I'm trying to sell covered calls, it gives me the yield of almost 11% on a stock that pays a 2.3% dividend yield. So I'm increasing my yield from 2% to roughly 13%. Very attractive cover call yields on this Walmart trade. And notice how it selects a cover call that has a 79.67% probability of this call expiring worthless. This is how I gain consistency, because it constantly selects cover calls based on probabilities and not anything else. That's how we're able to get consistency month after month, quarter after quarter, year after year, is by using this probability way to select my strikes. For those of you that like to sell puts, you can click on the no button and it'll present you a short put opportunity. So if you want to sell puts on Walmart, it's telling you to look at the May 18th 84.5 puts. This is also a strategy that you can use as an alternative to buying that stock. And I just want to show you how easy it is to click on a symbol and within a few seconds know exactly which cover calls to sell, and compare that to using an option chain. You know, when you're using an option chain, you have to type in the symbol, you have to select an expiration date, then you have to scroll through hundreds, if not thousands of strikes prices just to find the delta. Once you find the delta, you have to look at the premium, calculate the yield on that premium. It's a lot of manual work. With an options play tool, you don't have to do any of that manual work. You can simply click on a symbol and know within 2 seconds whether there's an opportunity or not and how much yield you're going to get for that. So with that, what I'm going to do is I'm just going to go back to the slides real quick. I promised you guys I'll talk a little bit about exit strategies. It's very important for you to understand what to do once you've sold a cover call. And there's generally 3 scenarios that you're going to come across once you sell a cover call. You can sell a cover call and the stock can shoot higher, the stock can move sideways, or the stock can drop. So let's talk about the 3. And the most important one, which is usually where most people tend to get a little panicked, is they sell a cover call and the stock shoots up and maybe it goes above your strike price. And the key here is to actually not panic. You really want to hold onto your cover call even if the stock goes above your strike price, and you only want to roll this cover call, meaning buy it back and sell another one, if you're in the last week before expiration. You don't want to do this early, because if you do it too early, you're effectively locking in a loss on your cover call, and you're not giving that stock an opportunity to potentially drop back down below your strike price near expiration. So if you have a month left to go and it's going above your strike price, don't panic. Hold on to it. You want to capture that time premium over the next month. That's really why you're selling this cover call. And then if you have to roll, meaning if the stock stays above its strike price, do it within the last week before expiration. The second scenario, if you sell a cover call and the stock kind of just trades sideways and goes neutral, this is kind of your best case scenario when you're selling a cover call. This is where you generally want to hold your position until expiration, let your call expire worthless, and come back the following Monday onto options play and find another cover call to sell. Lastly, if you sell a cover call and the stock drops, this is certainly not ideal, but this is really the only case where you want to roll your position early, meaning buy back the call that you've sold. You might have sold the call for $1. If you can buy it back for 20% of the premium or smaller, so if you sold the call for $1 and you can buy it back for less than 20 cents, do so and sell another cover call. You want to get right onto that and sell another cover call to help offset some of the losses that you have in the underlying stock. So those are the 3 general scenarios that you'll come across when you're selling cover calls and how to handle them. And I'll just do a quick recap here. For those of you that have questions, please, you can type them into the chat window. I'll answer those questions as they come in. I just want to do a quick recap for those of you that are maybe joining us a little late. When you open up options play, make sure you set up a watch list with the stocks that you own in your account, because it's going to make your process of finding cover calls a lot easier. And make sure that when you go to the income tab, you first use the income settings. The income settings is where you're going to want to put in your preferences, whether you want a short-term, medium-term, or long-term cover calls that you sell, and conservative, optimal, or aggressive when it comes to your risk tolerance. Once you set them, that's it. That's all you have to do. And for any stock that you click on, it'll instantly provide you with the cover call that most suits your personal preferences. So I hope you guys have found this useful. And like I said, this webinar is recorded, so please, if you have any questions, please type them into the chat window. I'll answer as many questions as I have time for. I thank you guys for taking the time out this afternoon. I hope you guys find these webinars useful. So let's take a look. Will the slides be available later? Yes, so I will be including the slides in the recording of the webinar that I send out in about an hour. I have a question here. Can I use Amgen as an example of medium term or short term? Sure, Amgen. So Amgen's trading at 175. This is telling you to take a look at this is for short term. This is telling you to look at the May 18th 182.5 cover call. So roughly $7.50 out of the money. So this is, as you can see, the May 18th 182.5 cover call generates a 9.2% yield on a stock that pays a 3% yield. So tripling your yield to about 12%. So certainly a trade to look at. Roughly a 77% chance that this call is going to expire worthless. So that's taking a look at Amgen. Matt's asking, where can I see the delta on this example? You can actually click on the share button, and at the very bottom, we'll show you the delta. So as you can see here, we'll show you the delta here. You can find that by clicking on the little share button on the trade, and at the bottom, there's a button that says explain strategy in Greek. So you can see the Greeks right down here, which includes delta. I have another question here to ask. Use PG, so Procter & Gamble. So Procter & Gamble's a 1-year low, trading at 72.75. This is telling you to take a look at the May 18th 75 cover call. So about $2.50 out of the money, a 6.6% yield on a stock that pays a 4% yield today. So you're still boosting your yield from 4% to about 10.5%. So certainly still consider looking at. So especially if you own PG, this is probably a stock that you're hurting a little bit on. This income helps offset some of that losses that you have on the stock. What are your thoughts on closing out a cover call a day or two before expiry when over 90% of the premium is made? So if you're 2 days to go and 90% of the premiums are made, it really depends on whether you're trading above or below the strike price. If you're trading below the strike price, let it expire worthless, simply just because of the fact that you don't necessarily want to have to pay another transaction cost to close it out for that extra day or two. But if you still have 2 weeks left and you can buy it back where 90% of your premium is made, then you definitely want to close it out early. If it's just a couple of days, then I usually say just let it expire. Let's take a look at Starbucks real quick. Starbucks, 59.38. This is telling me to look at the May 18th 62.5 cover calls, trading at 11% yield on a stock that pays a 2% yield today. Very attractive look here on Starbucks, in my opinion. So this is a cover call that's roughly $3.50 out of the money, or about $3 out of the money in the next 22 days, and gives you about a 12% yield. Let's take a look at some. Robert's asking, what if I don't own any of the stocks that you have mentioned? Great question. You type in the stocks that you do own. So if you have a stock that you own, let me know. I'll type it in, and you can see what it shows up at. That's the point of this platform, is that you put in your own stocks. I'm just showing you how to use this platform. You can type in any stocks that you own, and this will work for you for those stocks. Nil's asking, sometimes when I click the trade button, nothing happens. I'm not sure what you mean by that. Maybe you can send us an email separately at info@optionsplay.com. I'm happy to take a look at that for you. But generally speaking, when you hit the trade button, you get that strategy checklist. Charles is asking, I use 30 cents as a minimum premium. So we don't use a dollar amount, because the dollar amount doesn't matter, because if you're trading a very low price stock, 30 cents may be very small, but if you're trading a stock that's trading at $300, 30 cents is nothing. So that's why we use yield. You should use the yield as your determining factor as to whether there's enough yield in this cover call, because dollar amounts don't mean anything. You want to look at how much yield you're getting. Okay, so that's why we use the yield and compare it to the dividend yield. That's how we know, are we getting enough premium? Can I import a watch list from Thinkorswim? You cannot at the moment, but you can type them in really easily. We made it super easy. You can type in a bunch of symbols really quickly and import your watch list. Why not, Keith is asking, why not just set the strike price at a point you'd be happy to sell it, then sell the cover call and get a sign if it happened rather than roll it? So Keith, if you don't mind losing your stock, fine. Or if you want to sell your stock, that's okay. But this is about gaining consistency in income, right? Selling cover calls is is a strategy to generate an income stream for you. So, but if you're happy to sell a stock at a specific price, you can certainly do that. But that's kind of a one-off. That's not trying to sell cover calls for income. If you're trying to use cover calls for income, you want to set a strike price based on probability so that you have a consistent income stream month after month, quarter after quarter for the stocks that you own in your account. Toby, at the moment, we don't have a way to import your watch list by Excel, but certainly if you shoot me an email, I can certainly see if there's anything we can do to help you out there. Azam is asking a great question. Is there a screener to find the best cover call opportunities for the day? Azam, we don't do that because cover calls is a strategy for the stocks that you own in your account. You wouldn't go out and buy 100 shares of Starbucks just because it has a good yield. It's not worth the risk because you're risking $5,779 to buy 100 shares of Starbucks to try to make $41. That's not worth it. This is only a strategy for if you already own Starbucks, then you want to generate some yield on your portfolio. So that's why it doesn't make sense to scan for cover call opportunities. I have a question here for CMA. Comerica trading at 95.70. Interesting thing, as you can see on Comerica, it's telling me that I could not find you a short-term optimal cover call, which is my preferences. We're displaying to you the next best alternative, which is medium-term optimal. So based on this, we're not able to find a short-term call, and it's probably because there are not many short-term calls. So as you can see on the Mays, there's probably not a lot of strike prices here. So the 100 is only 85 cents. That's probably a bit too aggressive. The 105s have too little premium here. So this is why, this is an example here where if you're trying to sell cover calls on Comerica, this is telling you that maybe this is not a stock that you want to sell cover calls on because we could not find one that suits your criteria. Let's see. What does the score mean? If you're talking about the score here, this is a relative strength ranking. This is telling you how strong the stock is compared to the overall market. So a score of 5 tells you this is pretty much on par with the market. It's not really outperforming or underperforming the overall market. It's on a score of 1 to 10. 10 are the strongest stocks in the market, 1 are the weakest stocks in the market. And it gives you a quantifiable way to know, is the stock performing on par with the market or lagging or leading? I have a question here about credit spreads, and I would love to answer that, but I don't want to deviate too far away from this topic. So if you have a question about credit spreads, please ask us. You can click on the Questions Ask Us button here in the upper right-hand corner. I'm happy to answer any specific questions regarding credit spreads, but I do want to focus today's webinar and questions on some of the things that we're talking about here today. Bob's asking, percentage returns are overstated because transaction costs are not reflected. You're absolutely right. We are not reflecting in your transaction costs. That's something you have to consider into your cost. This is something that you want to definitely consider when you're entering your trades, but no calculator currently calculates your commission simply because we don't know what your commissions are. But these days with unless you're trading at somewhere really expensive, most of the discount brokers now are trading just a few dollars on a trade. So we're finding commissions right now to be very, very cheap for most people. A lot of people trade at places that commissions are really $2-3. Sometimes, even on the more expensive side, it's really pushing $4 or $5. Do you have a recommendation on how many contracts to buy when you have thousands of shares of a particular stock? If you're asking how many contracts to sell as opposed to buy, so most people will usually start by selling cover calls for at least a portion of their account if you have thousands of shares. So it depends on whether or not you are okay with losing that stock. If you're okay with losing the stock, you might want to cover a third to a half to start with. If you don't mind losing the stock, then you can sell all. If you have 1,000 shares, you can sell 10 contracts. So basically, for every 100 shares you own, you can sell 1 contract of a cover call. Charles is asking, what about buying back the call when the dividend is coming up? That's only a concern if the call that you've sold is in the money. So if the stock is trading above the strike price and you have a dividend coming up, that is the only time when you have it. If it's trading below the strike price, then you have no risk of that of early assignment on that particular trade. What do you do if the stock falls? This is really the only time where you want to buy back that call early. And the rule of thumb is if you can buy it back for 20% of the premium that you sold it for, that's a time to buy it back and sell another cover call. Karen's asking about dividend risk. Again, if you sell this 182.5 cover call on Amgen and near the expiration date, let's say it's May 15th. Well, I don't know if Amgen does actually have a quarterly dividend on May 6th. So again, very good question. So if on May 15th or May 14th, right before this dividend's about to get paid and the stock's trading above 182.5 cover call, that's when you have dividend risk, and you should buy back your call before May 16th to avoid early assignment. But if it's trading below 182.5, then you don't have to worry about it because you won't have an extrinsic value greater than 132, which is what causes someone to essentially exercise a call early. Ray, great question, Ray, about trade ideas. But again, I want to focus our questions today on cover calls. So if you have additional questions about the platform, like how our trade ideas are generated or anything like that, please click on the questions, ask us. I'm happy to answer all of those questions. Michael's asking, again, I have another question here. How does spreads work? I'd love to answer that question, but I want to keep our questions focused to this specific webinar. What is the maximum percentage return that's reasonable to consistently expect? Well, that depends on how far out you go and how aggressive you get. As you can see, the 5 to 10% range is kind of what you would normally expect. If anything above 10%, I would say, is on the higher end of the spectrum. Anything below 3%, I would say, is generally not good enough. 2 to 3% is pretty much the bare minimum because most stocks will pay you somewhere in that 2 to 3% dividend yield range. So 5 to 10%, I would say, is generally what we see as reasonable. A great question by David. Should I avoid selling calls on stocks that are trading at less than the price that I bought them? Great question. So generally speaking, as a rule of thumb, if you, because you do have the risk of losing that stock, and if you're really uncomfortable at selling a stock at a loss, then I would say avoid selling cover calls. But generally speaking, that's not the case because, so for example, for the stocks that you're trading at less than the price that you bought them, you might want to sell conservative cover calls. So minimize the risk of you losing your stock, but you want to generate some income because that helps offset some of that losses you have on the stock. So I would argue that because the stock's trading below the strike price, you would definitely want to sell covered calls to help make up some of those losses. But I can understand why some people don't want to take that risk, and that's completely up to you. So whether you want to take that risk, but my viewpoint on this is that, especially on the stocks that are trading less than the price that you bought them, sell cover calls to help recuperate some of those losses. Robert's asking QQQ. Sure, you can do this on indices as well. So if you own the Q's indice and you want to take a look at selling cover calls on this, and many of you do, right? I certainly own this index in my account. I own a lot of ETFs in my account. So this is something that you can also do. You can sell cover calls on ETFs. So QQQ pays a 0.82% dividend yield because it's a tech-heavy index. It doesn't have a lot of yield. Adding a cover call is one way to potentially add yield to your portfolio. One question is asking, how is POW calculated? So we use our own probability density calculations to calculate probability of expiring worthless, but it's calculated using the implied volatility of an option to derive what is the probability of the stock being above 169 or below 169 on the expiration date of May 18th. Let's see. Tangy's asking, this cannot help with doing a buy right transaction? It absolutely can. So you would do it the same way. So if let's say if you want to buy a stock to sell a covered call, whatever stock you want to buy. So let's say you want to buy Harley Davidson, type in the stock. It'll just simply tell you which cover call to sell with that buy right. So you can buy the stock and sell a cover call at the same time. That's all done on your brokerage account. David's asking, how do you buy back in the Amgen example? So you would simply, when you sell a cover call, the order is a sell to open. So if let's say you want to sell this trade, as you can see, the order is a sell to open. When you're ready to close it, you just simply buy to close. So the buy to close is the opposing order to sell to open. Yeah, so actually a great question. A lot of people ask us, how do we get to the webinars that we've done? So I'm going to send a link right now. This is how you can find all of our videos on our YouTube channel. I just sent everyone a link. That's really how you can follow us. You can, especially if you don't have time to get to all of our webinars, getting to our YouTube channel has all the pre-recorded webinars there. Highly recommend if you want to learn about some of the other strategies. I know there was a lot of questions about spreads. We have webinars just on those. Make sure you take a look at that because that is going to help you answer some of those questions as well. I have a question here is saying, does options play prompt the user that a cover call exists and is near expiration? So currently we do not, but for those of you that are subscribers to options play, we do have a new portfolio tool that we've been testing out for quite some time. You can have access to it. If you're a subscriber, please just send us an email after this webinar and we can get you sorted with that. We cover most of the major brokers that allows you to import your positions and take a look at your cover calls near expiration. What is the potential of buying Procter & Gamble and selling cover calls? I'm not sure what that question means. You can certainly buy Procter & Gamble and sell cover calls, but I wouldn't go out there just to sell a cover call. I would only buy Procter & Gamble if you actually want to own that stock. How do I know when to get in and out of a stock trade? Great question. Well, that's one of the answers, one of the questions that we answer in our directional view webinar, how to gain your directional view. So please look at our YouTube channel link that I just sent out to everyone in the chat window. We have a specific webinar on how to use our technical score and our directional indicators to give you a directional view. And that is something that you can use to help you determine when to get in and out of a stock trade. Keith is asking, selling cover calls helps to lower cost basis. So if stock is below your original purchase price, you can try to equalize your stock starts back up. Yeah, that's correct. I don't own any stock, but I want to trade options for consistent income. So if you don't own any stocks, there's a couple of ways you can do this. You can still sell these calls, but you just have to sell credit spreads. So that's a bit more, like you said, a bit more of a complex strategy. But I actually have another video on our YouTube channel, which again, please take a look at our YouTube channel with the link that I just sent out. We have one specifically on selling credit spreads. This is one of the ways that you can generate income by selling calls and puts, but you just have to buy back a further call or a put to limit your risk. Okay, guys, I'm starting to run out of time here. We're past the 1 hour mark here. I just want to thank everyone for joining me this afternoon. Again, I hope you guys have found this useful. It was very interesting to find that most of you use the option chain to find your cover calls to sell. And I really hope that this webinar helps inspire you to consider taking a look at options play, not only to make your lives easier, but more importantly, to help you guys gain consistency in the strategy. You know, many of you own stocks in your account. Maybe some of you know how to sell cover calls, maybe some of you don't. I hope this webinar really helps you guys get started with this process and help you do it month after month, quarter after quarter, and not just when you remember it, because that's what we tend to do is we only sell cover calls when we have the time or if we remember to do it. Options play is really designed to help you do it on a consistent basis. And I really hope that you guys saw that. So like I said, this webinar is recorded. We'll send out the recording to you guys, and very quickly, as soon as I have this ready, I'll have the slides for you guys as well so that you can follow along. And if you have any questions, please click on the questions ask us button in the very upper right hand corner. Those questions come directly to us. We'll be able to answer those as quickly as possible. So thanks everyone for attending. I don't believe we're going to be doing a webinar next week, but we will be back the following week. I'm going to be at a conference next week. So I'll be back in 2 weeks, and we'll restart the webinar series in 2 weeks, and I'll see everyone there. Have a great afternoon.